Welcome to the Opening Bell Report.
So 355%. I really just want you to sit with that number for a second.
Yeah, it is a completely wild figure.
Right, because in the corporate world, if a mature company grows revenue by, say, 10%, they pop the champagne. If a high-flying tech startup hits 50%, they are the absolute darling of Silicon Valley.
Oh, for sure.
But 355% year-over-year growth, that is not just an uptick. That is a
completely different species of number entirely. It's a multiplication.
Exactly. And honestly, when you see a number like that on a balance sheet, it usually signals one of two things to me. Either it is a total anomaly, like some one-off accounting trick or a lucky break, or it signals a fundamental shift in the reality of the business.
And that fundamental shift is exactly what we are unpacking today. We are looking at a company called IREN Ltd. Now, depending on how closely you follow the markets, you might know them as a Bitcoin miner, or you might think you know them.
Because the analysis report we are breaking down today suggests that the label of Bitcoin miner is becoming less and less accurate by the hour, frankly.
That's right. The report we have in front of us is titled The IREN Transformation, Scaling AI Infrastructure and Market Dominance. And that title really gives away the game here. This isn't just a crypto story anymore.
No, not at all.
This is a story about a company pivoting and pivoting hard to become the physical backbone of the AI revolution.
So here is the mission for today's deep dive. We are going to unpack that eye-watering 355% revenue growth and really look at why Wall Street is screaming buy on IREN. We are going to see where the money is actually coming from.
Which includes a massive $9.7 billion contract with Microsoft that really seems to be the engine behind all of this.
Yeah, we definitely need to get into that. And we have to talk about the physical side of this too, the moat. Because everyone and their mother says they are doing AI these days, but IREN is building the actual physical plumbing.
The concrete, the copper, the cooling.
Right, to make it actually happen. And finally, we will look at the risks. Because you know you don't grow this fast without burning cash. We will talk about the J-curve and why Wall Street is so bullish despite the heavy spending.
It really is a fascinating case study in how to pivot a billion-dollar business in real time.
Let's start with the headline then. The financial explosion. The report lays out the recent quarterly numbers, and frankly, they are staggering. We are talking about record revenue of $240.3 million for the quarter.
To put that in perspective, you really have to compare it to the prior year. In the same period the year before, they brought in roughly $52.8 million.
Wow.
Yeah, so that is where you get that 355% jump. It is almost difficult to wrap your head around that kind of velocity. The report calls this a hyper-scaling phase of their business model.
It is incredible.
Yeah.
But we have to ask the obvious question, right? Bitcoin has been on a tear recently.
Yeah.
Is this just a case of the price of Bitcoin going up and IREN just riding the wave? Like, is this just beta to Bitcoin?
That is the assumption most people make. And look, they are still mining Bitcoin, so that is part of the cash flow. But the report explicitly corrects that assumption.
Okay.
It emphasizes that the primary fuel for this explosion is something else entirely. It is the rapid deployment of AI cloud services.
So they are taking the infrastructure they built for crypto, the data centers, the power cables, and basically aiming it at ChatGPT.
In a nutshell, yes. But it is more than just aiming it. They are fundamentally re-architecting their business model. They are moving from a volatile commodity-based business like crypto mining to a highly stable recurring revenue model with high-performance computing.
And the profitability metrics really show that it's working, don't they?
They do. Adjusted EBITDA surged to $91.7 million for the quarter.
And for those of you listening who might not live in financial statements every day, let's just quickly define that. EBITDA is earnings before interest, taxes, depreciation, and amortization. Basically, it's a proxy for the raw cash flow the business generates from its core operations.
Exactly. It strips away all the accounting noise. And hitting $91 million in a quarter means they aren't just bringing in top-line revenue, they're actually keeping a really healthy chunk of it.
Right.
It shows that the underlying engine of the business is incredibly efficient.
Okay, so the growth is real. But growth needs a catalyst. You don't just wake up one day with 300% more revenue. And this brings us to the centerpiece of the report, which is the Microsoft mega deal.
Yeah, this was the part of the research that honestly made me do a double take. We aren't talking about a small pilot program here or a proof of concept.
Yeah.
IREN secured a multi-year AI cloud contract with Microsoft.
And the value attached to this deal over its lifespan is nearly $9.7 billion, according to the report.
That is practically $10 billion. It is massive.
It is massive validation, too.
Definitely. You have to understand, Microsoft is arguably the largest company in the world. When they sign a check that big, it tells the broader market two distinct things. One, they are desperate for capacity. We know there is a global GPU shortage. Everyone knows that.
Yeah.
But two, and more importantly, it says they trust IREN's technology to actually deliver it.
Right, because Microsoft isn't going to risk its AI reputation on a scrappy miner working out of a garage somewhere.
Yeah,
This validates IREN as institutional-grade infrastructure.
precisely. Microsoft has intense service-level agreements, uptime requirements, security protocols. If IREN can meet those benchmarks for Microsoft, they can meet them for literally anyone.
And the report mentions it isn't just Microsoft either.
No, they aren't putting all their eggs in one basket. The report lists contracts with other AI clients like Together AI and FluidStack as well. But Microsoft is the anchor. It provides the stability and the cash flow visibility that Wall Street just loves.
Speaking of visibility, the future projections in this report are pretty wild. Based on these deals, where do they see this going over the next few years?
The report forecasts that driven by these deals, IREN will hit an annualized AI run rate revenue, or ARR, of $3.4 billion by the end of 2026.
$3.4 billion in annual recurring revenue. That puts them in the league of major enterprise software companies. But here's the logistical question I have. How?
Right, the execution.
Yeah, to service a $10 billion contract, you need a lot of computers. You need a lot of chips.
A lot of GPUs specifically. And this is where the sheer scale of their ambition becomes clear. The report outlines a very aggressive plan to scale their capacity from 23,000 GPUs to an astonishing 140,000 GPUs.
Whoa, going from 23,000 to 140,000? That is almost a 6x increase.
Yeah.
That is not just buying a few extra server racks at Best Buy. That is a massive logistical undertaking.
It is immense. And honestly, this is usually where companies fail. It is one thing to sell the contract right. It is another thing to physically plug in that many high-performance chips without melting down your entire data center.
Exactly.
The logistical complexity of deploying 100,000 H100s or H200s is just mind-boggling.
Which leads us perfectly to the secret sauce section of the analysis report. Because I was wondering, how are they doing this when everyone else, Google, Amazon, Meta, they are all fighting for rack space right now?
The answer lies in what the report calls their infrastructure moat. Specifically, IREN operates on a vertically integrated model of total ownership.
Okay, total ownership sounds a bit like a marketing buzzword. Let's unpack that for a second. What does that actually look like on the ground for them?
So typically, a tech company might rent space in a data center owned by a massive provider like Equinix or Digital Realty. Or they might buy the chips themselves but hire a third party to manage the cooling and the power. It is a highly fragmented supply chain. You are constantly dependent on other people's schedules.
Right, you're waiting for the landlord to fix the AC or upgrade the power lines.
Exactly. IREN does it all themselves. They procure the raw land. They build their own high-voltage substations.
Which we should note is a huge engineering feat in itself. You don't just plug a high-voltage substation into the wall.
No, that takes years of permitting engineering and heavy construction. But they do it. They construct the physical data centers from the ground up. And crucially, they design their own liquid cooling architecture.
So they literally own the dirt, the power plug, the building, and the cooling system? They aren't relying on a landlord at all.
Exactly. This eliminates reliance on third-party colocation providers entirely. Think about it. If you need to expand rapidly to meet that massive Microsoft contract, you don't have to call your landlord and ask if there is space or wait for them to build a new wing. You just go out and build it yourself.
And that speed of deployment is a massive competitive advantage. In the AI race right now, speed is basically everything.
It is the only thing.
I want to double-click on the cooling aspect you mentioned, though. Why is that so important? Why can't they just use big fans like everyone else has been doing for decades?
This is a really key technical point that the report highlights. The new generation of AI chips, like the NVIDIA H100s or the upcoming Blackwell chips, they run incredibly hot. They're so dense and they draw a massive amount of wattage. If you put them in a traditional data center that uses air cooling, which is just blowing cold air down the server aisle, you basically have to space the racks out so much to keep them from overheating that it becomes totally inefficient. You simply can't cram enough compute into the room.
So air cooling is just hitting a physical limit at this point.
Right. It's simple physics. Air just isn't dense enough to move that volume of heat away fast enough. So IREN uses liquid cooling. They are effectively using direct-to-chip cooling methods that transfer heat away much more efficiently than air ever could.
And that allows them to pack more GPUs into a smaller footprint, which lowers their physical costs and increases the speed of the cluster.
Exactly.
So because they designed their centers for crypto mining originally, which also runs incredibly hot, they sort of accidentally built the perfect home for AI.
Well, I wouldn't say accidentally, but yes, the heritage definitely matters here. High-performance computing is high-performance computing at the end of the day. They cut their teeth on mining rigs, which require massive power and cooling density.
Makes sense.
That expertise translates perfectly to AI clusters. So while traditional data centers are scrambling right now to retrofit their older buildings for liquid cooling, IREN is already there. They've been doing it.
And there's another layer to this infrastructure moat that the report highlights, which I think is becoming the single most important resource in the world right now. Energy.
You hit the nail on the head. We are living in a fundamentally power-constrained world. AI models are incredibly thirsty. They consume massive amounts of electricity. You've probably seen the headlines about data centers consuming as much power as small cities.
Oh, yeah. The grid in places like Northern Virginia is completely tapped out.
So even if you have the chips, if you can't plug them in, they are just very expensive paperweight.
Exactly.
And this is huge. The report notes that IREN already has gigawatt-scale power secured.
Gigawatt scale. That is nuclear power plant territory.
Yes, it is. While other companies are waiting 3, 4, maybe 5 years for the utility company to hook them up to the grid because the grid is congested, IREN already has the power secured. They have the substations built. They have the agreements in place. And there is a cherry on top of all this, too.
What's that?
It is 100% renewable energy.
Right. The ESG appeal.
It matters. It really matters. For a company like Microsoft, or really any mega cap tech firm, they have very strict carbon neutrality goals. They have promised their shareholders and the public that they will be carbon negative in a few years.
So they cannot just burn coal to run their AI models.
Exactly. It's a massive reputational risk. The fact that IREN can offer massive gigawatt scale and 100% renewable power makes them incredibly attractive to these ESG-conscious clients. It solves 2 giant problems for Microsoft at once. I need power and I need it to be green.
So let's recap the bull case here before we get to the stock talk.
Yeah.
You have massive revenue growth, 355%. You have a $10 billion contract with the biggest company on earth. You own your own power and infrastructure, and you have the technical capability to cool the chips that everyone else is struggling with. It sounds like an absolute slam dunk. So what does Wall Street actually say?
Well, according to the analyst sentiment section of the report, the consensus is overwhelmingly bullish. They literally use the phrase screaming buy.
I always get a little skeptical when analysts get emotional like that. Screaming buy sounds like a late-night infomercial. What are the actual numbers backing that up?
The data is strong. About 81% of the analyst recommendations represent a buy or a strong buy. That is a very high consensus rate. Usually you have a lot more dissent on a transitional company like this.
And what about the price targets? Because the stock is trading around, what, $42 right now?
Right around there, yeah. The average price target listed in the report sits between $74 and $80.
So that implies an upside of roughly 80 to 90% from current levels.
You're effectively doubling your money if they hit just the average target. And if you look at the street high target mentioned, it goes up to $125, even $136.
Wow. Okay. But talk is cheap, right? Analysts can issue fancy targets all day long. Is anyone actually putting real money down?
They are. The report explicitly mentions smart money moving in. It specifically cites Cantor Fitzgerald, a major institutional player, recently loading up on millions of shares.
And Cantor Fitzgerald isn't a retail day trader on Reddit. They are heavyweights.
No, not at all. When institutions like that start buying in bulk, it usually means they have done deep fundamental due diligence on the infrastructure thesis. They aren't just betting on a crypto pump. They're betting on the physical data centers. They have likely sent engineers out to inspect the facilities. They've crunched the numbers on the Microsoft contract.
They believe the story.
They believe the pivot is real. They view the recent stock pullback not as a failure of the business model, but as a strategic entry point to acquire shares on the cheap.
Okay, hold on. I have to play the devil's advocate here. I have to be the bear for a minute.
Let's hear it.
If everything is so perfect, if the growth is 300% and Microsoft is writing blank checks, basically, why is the stock volatile? Why isn't it already at $100? Why do bears worry so much about free cash flow burn?
That is a very fair question. It brings us to the elephant in the room.
Yeah.
And it is a concept the report breaks down called the infrastructure J-curve.
The J-curve. Okay, walk us through this. I think this is a crucial concept for understanding why their financials look the way they do right now.
So imagine the letter J on a graph. The line starts by going down deep into the negative territory before it loops up and goes totally vertical. That initial dip, that negative part, represents capital expenditures or CapEx.
Spending money.
Spending a lot of money. Think about what we just discussed. They are aggressively front-loading money. They are building massive substations. They are buying 140,000 GPUs.
And NVIDIA hardware is incredibly expensive.
Insanely expensive. A single H100 chip can cost upwards of $25,000 or $30,000. Multiply that by thousands. Plus, you have the concrete, the copper, the massive transformers. IREN has to front load all of this cash before they see a dime from the client.
So on the short-term financial statements, it looks like they're just bleeding cash like crazy.
Exactly. And this causes what the report calls margin compression. In the short term, their net margins look really squeezed because they are pouring every single available dollar back into buying hardware and building physical buildings.
And that naturally scares some investors. They look at the free cash flow and say, wait a minute, this company is burning money.
Right. It takes a certain kind of stomach to watch that burn rate. But the report argues that Wall Street, the smart money part of Wall Street anyway, is forgiving this short-term cash burn.
Why? Why forgive a massive cash burn?
Because of the long-term bet and the unit economics at the end of the tunnel. This isn't burning cash on marketing campaigns or Super Bowl ads. It's asset-backed. They are essentially buying money printing machines.
The payoff.
Exactly. The report projects that once that hardware is racked, plugged in, and turned on, the recurring revenue from the AI cloud compute creates exceptional gross margins.
How exceptional are we talking?
They are projecting around 85% project EBITDA margins.
85%. That is software-level margin on hardware infrastructure. That is almost unheard of in traditional manufacturing or real estate.
Precisely. That is the massive payoff of the J-curve. You suffer the heavy cash burn now to build the machine. But once the machine is fully built, the operating costs are relatively low compared to the massive revenue it continuously generates.
It becomes a cash printing machine.
A cash printing machine that is crucially entirely independent of Bitcoin's price fluctuation.
And that is the absolute key to this whole story, isn't it? If Bitcoin crashes tomorrow, but Microsoft still needs to run its AI models, IREN still gets paid.
That is the ultimate end state. To decouple their fate from the highly volatile crypto markets entirely, they want to be viewed by the market as a reliable utility provider for the AI age, not a speculator on digital coins.
It really is a story of a business growing up, moving from the wild west of crypto mining to the corporate boardroom of enterprise AI. It feels like they are graduating.
They are, and that raises a really provocative thought for the future, one that isn't explicitly answered but is heavily implied by this entire analysis report.
What's that?
If IREN succeeds, if they execute this J-curve perfectly and become a pure-play AI infrastructure giant with billions in recurring revenue from Microsoft and others, does the market eventually stop seeing them as a miner entirely?
Right, do they finally lose the crypto stock label?
And if they do, what does that actually do to their valuation multiple? Because tech infrastructure companies like data center REITs and cloud providers trade at very different multiples than crypto miners.
Oh, absolutely. Crypto miners usually trade at a massive discount because of the inherent volatility of Bitcoin. Infrastructure plays trade at a huge premium because of the stability of their contracts.
So if the market re-rates them, if the market decides to price IREN like a highly stable data center REIT instead of a volatile Bitcoin miner, that upside we talked about today might just be scratching the surface.
That doubling of the stock price could just be the beginning of a complete repricing of the asset.
Exactly.
That is the big if for you to mull over. But the Microsoft contract certainly suggests they are on the right path to getting there. They are attempting to solve the single biggest bottleneck in AI right now, which is the physical infrastructure to actually run the models.
It is the strongest signal they could possibly send to the market.
So the question for you listening is it a miner or is it the next great infrastructure utility? The numbers certainly suggest the latter, but the market is still making up its mind.
It is going to be a really fun one to watch play out.
Absolutely. We will definitely keep an eye on those upcoming quarterly reports. Thanks for taking this deep dive with us today.
Always a pleasure.
Don't forget to like, share, and subscribe for more.